In this video, we're looking at an example to show how loan offset accounts work and how significant amounts of interest can be saved.
Let's look at an example of how a loan offset account might be used to assist a client. In this scenario, we've got a client with a $250,000 loan at an interest rate of 7.3%, where the daily interest cost works out at $50 per day. Now, the way an offset account works is that each dollar that is held within the offset account effectively reduces the daily interest cost. Now, in this example, we've got a client where they have a large sum of money, $125,000 in this case, that's going to be flowing through their account for 3 days. So this might be a business transaction that happens to sit in their account before it then gets used for whatever it's being used for. So in the table here you can see that in an average week, so a 7-day week, this client has an outstanding loan of $250,000 where the daily interest in normal circumstances would be $50 per day or $350 in the week. Because in this particular week the offset account is going to have $125,000 in it for 3 days, so the Tuesday, Wednesday, Thursday, the net interest, rather than being $50 for that Tuesday, Wednesday, Thursday, is going to be $25. So over the course of the week, this client has saved $25 of interest each day, or $75 in total. And the key with using the offset account is rather than having deposited the $125 into a high interest bearing account such as an online saver, the client has saved an expense or saved their interest costs. So this works in two ways, because one, a high interest online saver chances are would not be paying an interest rate anywhere near the lending rates that would apply to a loan. So at 7.3%, a client would be lucky to probably get anywhere near 6. So one, they're getting a higher effective interest rate, but two, because they're not actually earning income, they're just saving an expense, there's no tax liability on the interest that has been earned. So had that have gone into an online saver account, and even if the client could achieve a 7.3% return, which would be unlikely, the earnings on that 7.3 would be charged at the marginal rate and effectively reduce the overall return for the client. So there's an example just to illustrate how a loan offset account might be used.
This has been Eddie from Curto Consult. Thanks for watching.